Hey, what's going on, everybody? This is Kwak here, one of the Kwak brothers. Now, Daniel and I recently discovered a home mortgage program that doesn't require credit. It's designed for low-income individuals, and it even allows for second mortgages to happen right on top of it. While this program has been around for a few years, this is the first time that the program has caught our attention. Now, Daniel and I typically spend hours of research figuring out what's going on in the market, the economy, the governmental policies, to see how it affects us, the real estate market, and how it affects you guys. Now, if you're like me, this is kind of feeling like 2005 and 2008 all over again, where, banks really didn't have any standards as far as who they're lending money to. Well, let's face it, even your dog and cats were able to qualify for these loans. Several weeks ago, Daniel and I made a video basically explaining and exposing a new scheme that the banks are working on to basically repeat 2008 all over again. Well, because if you think about it, the last time the big banks got a huge, massive sum of bailout money from the big government, even after the fact that they were the ones that made the mistakes. And pretty much almost all of them are here after the fact that they gambled with taxpayers' money. So what's stopping them from doing it all over again? But to be fair, there are new rules and regulations like the Dodd-Frank Act of 2012 that does put some limitations as well as some bit of protection for consumers from the banks. But come on, you and I know that big banks will always figure out a ways to make money from the masses, just like how I'll figure out how to get you to click on the like button on this video. Even with rules and regulations like Dodd-Frank Act, it didn't stop Wells Fargo from what they were doing in 2015 and 2016. So guys, I took one for the team and went deep and researched and figured out what this mortgage program is all about. Is it the repeat of 2008 all over again? Is it legit? Is it safe? Let's go and dig deep, and I'll share some of my concerns and ramifications it has with the housing market and how it's going to affect you. And just a little disclosure before we begin, I am not Fannie Mae or Freddie Mac, so by no way means I'm representing them. This is just my perspective and opinion about what's going on here. So the home mortgage program is called Home Possible, which is created by Freddie Mac. Now, Freddie Mac is a quasi-government organization that pretty much institutes policies and guidelines for lenders to follow if they want to lend mortgage products that are backed by the federal government. Now, I say quasi-government because Freddie Mac and Fannie Mae at one point were private organizations. And of course, after 2008 and 2012 fiasco, the government basically took over to provide oversight. And right now, of course, the current government administration is trying to exact more control and more power over Fannie Mae and Freddie Mac. What else would they do? Now, on Freddie Mac's own website, it says the program is specifically designed for first-time home borrowers, move-up borrowers, which means that individuals are moving from small homes to a bigger home, retirees, families in low-income census tract, and very low and moderate income borrowers. So basically, if you make too much money, you don't qualify for this program. So let me give you a quick rundown of some of the features of this program that are pretty striking, and I think you might find it pretty interesting. Now, number one is that just like FHA, this program allows for ultra low down payment of 3%. But unlike some of the FHA programs, the program is even allowing for down payment assistance, and in some instances, the lenders will allow for sweat equity. Now, real quick, guys, sweat equity does not refer to quote unquote serfdom. And to be serious, guys, sweat equity oftentimes refers to any kind of physical, mental, or timely effort you put into a property that increases the value. It typically means that you're doing any kind of repairs or improvements to the property so that it increases the value, which obviously helps with when it comes to the down payment part. So in many ways, this program does resemble in many ways like the FHA program, but here's where it gets even more interesting. Now, the second thing is that Freddie Mac is allowing for second mortgages to happen pretty much up to a maximum of 105% total loan to value, which means, let's say, for example, you bought a home for $100,000. The program will finance the first 97%, which essentially is $97,000 of the home price. Then, additionally, if you're eligible, Freddie Mac will allow for a second mortgage pretty much for another $8,000 with a grand total of $105,000 debt against a $100,000 home. Now, I suspect that their reasoning for this is that they want homeowners and borrowers to take the extra funds and apply it on remodeling projects and improvement of the property, therefore increasing the value of the property, which in turn should typically, and I say typically because it doesn't always happen, increase the value of the home, which ultimately the borrower doesn't owe more than what their home is worth. Now, we saw something similar happen back in 2005 to 2008, where banks will pretty much finance 80% just like the way they do now. But on top of that, they'll even finance second or third or fourth mortgages to cover the down payment, which ultimately meant that homeowners back in the day didn't have to put any money down, let alone very little credit to get financing to buy a home. And for that reason, the fact that Home Possible program is doing something similar to what we've done in 2005 to 2008, it does cause a little bit of concern for me, and I'm sure it does for you. So tell me what you think. Leave your comments down below. Is this heading to basically a 2005 to 2008 situation all over again? Or is this something legit or safe? Let me know what you guys think, and I'll of course share my thoughts and concerns later down in this video. Oh, and real quick, just like always, if you leave your comments down below in the first hour of us releasing this video, of course I'll comment and reply back and have a little bit of conversation with you guys in the comment section below. Okay, now the third thing, and probably the biggest eyebrow raiser, is the fact that this program does not require any credit at all. Let me say that again. No credit required. So instead of looking at credit, what Freddie Mac is mentioning and what they're willing to do is something called manual underwriting, which means that they're going to look at other factors such as debt to income ratio, their strength of their employment, their bank deposits, how often they get deposited, and maybe checking to see if they subscribe to the Kwak Brothers channel. Now, in all seriousness, guys, this means that the banks won't automatically deny the borrower based on their credit. They'll still accept the applications and take a look at it and manually underwrite to see if they're a good fit. And of course, traditionally, lenders will require a certain threshold of credit score to be required for the application to be even considered through the underwriting. So unlike the 2005 to 2008 situation, it does look like the banks are doing a little bit more careful documentation and underwriting, because back in 2005 through 2008, anyone was qualified for a mortgage, and if you were alive, then you were qualified. So while this program doesn't necessarily require credit, it does look at other factors to approve or deny for the program. So overall, guys, it doesn't look like this loan is a copycat of what we've seen in 2005 through 2007. It does look like Freddie Mac and its affiliate lenders are a little bit more careful than what we've seen in 2005 through 2007. They're requiring a little bit more documentation. They want to check income, tax returns. So it's not like a free-for-all, anyone gets a loan. It does require a little bit of documentation along the way. And in some instances, the program does require borrowers to go through home counseling as well as some education courses to be able to qualify for the program, which it's a good thing to make sure that the homeowner knows what they're doing. So guys, this program isn't terrible at all. I mean, especially for those individuals that need it, but it does cause a little bit of concern for me as far as what happens with the rest of the real estate market, micro and macro, and I'll share some of that with you right now. The first concern is that the fact that right now the economy is really unstable and there's a lot of uncertainty right now. A lot of investors have really no confidence and they're really unclear as far as what the next 3 to 5 years is going to look like, especially with inflation mounting on pressure on the currency, and we're at all-time high with national debt. Federal Reserve is at trillions of dollars in their balance sheet. There's certainly a lot of question mark right now whether this economy is going to be sustainable or not. And it's not really hard to find a lot of these speculative videos on YouTube, whether we're looking at a market crash or a bubble at this point right now. And that leads to my real concern is that if there is another event like 2008, 2009, or even COVID-19 situation all over again, well, my fear and genuine concern is that a lot of people are going to lose their income, their job, businesses are going to go down and shut down and close, which means that if it trickles down to some of these borrowers, to what I'm referring to, they're going to be hurt the most because they're in a very tight squeeze spot where their income goes down or their business goes down. Well, shoot, that means we might see potential for these borrowers going to foreclosures or default, which we definitely don't want to see. And almost 2 years ago, I started making predictions that FHA borrowers are probably at the biggest risk at this point, mainly because they have really low equity. And if there's ever an event that the market flips and all of a sudden we lose value in home prices, well, a lot of these FHA borrowers are going to end up with pretty much upside down situations underwater where they will owe more than what their home is actually worth. And of course, in the bank's perspective, if the underlying asset that's securitizing the loan goes down below a certain level, well, this will cause a lot of concern for the banks as well. And upon discovering this program and the fact that this types of program exists, well, my prediction has kind of changed where these types of home borrowers are at the greatest risk at losing their homes and losing their butt, essentially, if there was another repeat of 2008 in the near future. Because if you think about it, a lot of these borrowers are low income, very cash strapped, no credit, and they're in the teeter of if they lose something, then it could be a very bad situation for them. So you can kind of see why I'm concerned, and I'm kind of on the fence with this. It is a good program for a lot of people that need it, and at the same time, it could be a ticking time bomb under the wrong circumstances. And that leads to my second concern, and that is programs like these oftentimes create what's known as phantom appreciation. Now, I coined this term about 2-3 years ago, basically describing an unnatural appreciation of home value and real estate value in a given market. In other words, phantom appreciation is basically a rise in home value in a given area, not because there's a natural demand or growth, but access to credit and money has gotten easier. Therefore, there are more people that could potentially become a buyer in a given market. You see, natural appreciation is preceded by job growth, population growth, and a perceived favorable condition to actually buy a home. But when access to credit and cash becomes easier, just like 2005 through 2008, you create an artificial growth in demand. And this isn't necessarily a bad thing by itself, but under bad conditions and the wrong context, it can blow up on the homeowner's face, just like what we've seen in 2008 through 2012. But to be fair, I would say 2008 is on the extreme end of things, and that's probably one of the worst things that ever happened when it comes to residential home markets. So talking about bottom line as far as how it affects you and me is that programs like these do tend to increase the prices of homes because it pents up the demand. And with the fact that right now, big government wants to go and change all kinds of rules to make it easier to individuals to access credit, like the $15,000 first-time home buying credit, changing guideline rules as far as who gets approved and who doesn't, and changing some of the credit scoring models, which allows more individuals to get approved, we're basically going to see the continuing rise of home prices for the next 5 to 10 years, unless we see a whopping increase of supply with the home and real estate market. So if you're shopping for a home right now, or at least considering to buy a home in the next few years, I don't know if the home prices are going to ever fall down in the next 5 to 10 years, unless we see a big black swan event just like COVID-19. Especially with the direction we're headed to with easier access to credit, and we're going to see a natural demand with the next generation wanting to actually buy homes and become homeowners. So guys, as always, we're always tracking these changes and updates to government rules, housing market, the micro, macro, real estate. So definitely subscribe to our channel if you guys want the latest updates. And of course, we speak these truths and share these information through the lens of freedom-loving individuals. So guys, if you love and enjoyed this content today, be sure to subscribe and comment down below. And as a reminder, if you guys leave a comment in the next hour of releasing this video, I'll go ahead and comment and reply back to you guys and have a conversation right here in our video. So that being said, I'll see you guys in the next video.